Hello everybody, welcome back to my channel. Before a person starts investing, it is extremely important for the person to know the difference between a risk-free asset and a risky asset, or in other words, the difference between debt and equity. This is extremely important because an investor always has to have the right mix between debt and equity. So to find out the differences between debt and equity, watch the video till the end. So first we need to understand what is debt. Imagine debt like a loan that you're giving to somebody. So what do you expect when you give a loan? You expect a fixed rate of return from the loan, right? So let me give you an example. Assume that you go to a bank and you tell the bank that I want to create a fixed deposit. So what does the bank do? The bank says, well, okay, you give me the money and I will give you a fixed rate of return of 7% on your deposit. So what you're doing in essence is you are giving a loan to the bank and the bank is promising to pay you a fixed rate of return of 7%. So this in essence is you investing in debt, and this debt is risk-free because there is no risk attached to this investment that you're making because the bank has promised to give you a fixed rate of return of 7%. The bank can't give you more, the bank can't give you less as well. So now we've understood the meaning of debt. Let us move on to the meaning of equity. What is equity? Equity primarily means investing in companies' shares. So let me give you an example. Assume that you go and purchase Tata Motors share from the stock exchange. So what you're doing is primarily purchasing a small ownership in the company that you're investing in, which in this case is Tata Motors. So when you invest in shares of a company, what kind of return can you expect? Returns are primarily in the form of dividends. So what are dividends? Dividends are nothing but distributions that are given to the shareholders when the company makes a profit. Assume that Tata Motors, for an example, has made a profit of 100 rupees and there are 100 shareholders, which means there are 100 people like you who have invested in Tata Motors stock. So now what Tata Motors decides to do is that Tata Motors decides to pay dividend to all the 100 shareholders. Now since the profit of Tata Motors is 100 rupees and there are 100 shareholders, each shareholder will get 1 rupee as dividend, which is 100 divided by 100, which is 1. This again will be paid only if the company earns a profit. If the company earns a loss, dividends will not be paid. The other form of return that you can get when you're investing in shares of a company is capital appreciation on the investment that you're making. So let me give you an example. Assume that you purchase Tata Motors share for 100 rupees, right? This is just an example. And after 2 months, assume that the share price has moved up to 120 rupees. There are various reasons why the prices can move up. I'm not going into the details of that, but just assume that the share price has moved to 120 rupees and you decide to sell the share. So in this case, what happens is that you have purchased it for 100 rupees and you're selling it for 120 rupees. So in essence, you have booked a capital appreciation of 20 rupees. So this is again a return that you have got on the investment that you have made. It can also happen that the share price falls down to 80 rupees for an example. So in this case, you don't have any capital appreciation, but in fact you have a loss. Assuming that you sell it for 80 rupees, you have a loss in this case of 20 rupees. So to put things in perspective, when you're investing in a company's share, you are primarily investing in equity assets or risky assets. Why is this risky? Because as I mentioned in the example, the share price can move up or it can move down. If it moves down, you are in a disadvantageous position. But if it goes up, you obviously have something to gain as well. Similarly, if the company earns profit, you get dividend. But if the company makes a loss, you don't get dividend. That is why equity investments are risky investments. So now that we have understood the meaning of debt and equity, let us try to understand the differences between the two. So we'll categorize the differences into 4 major buckets. The first category is the meaning. Debt is nothing but a loan fetching a fixed rate of interest, whereas equity, as I mentioned, is investing in companies' shares. The second category of difference is on ownership. Now when it comes to debt, there is no ownership when it comes to such type of investments. In the example that I gave you of fixed deposit with a bank, when you go and deposit your money with the bank, you don't get an ownership of the bank, right? You just go and deposit money and you get fixed rate of return. So there is no ownership associated with such type of investments. When it comes to equity, when you're investing in Tata Motors share, for example, you do get a portion of ownership in the company that you're investing in. It is also called voting rights because once you invest in a company's shares, you do have voting rights when it comes to the important decisions the company takes. It will essentially take your consent when it comes to certain activities that the company wants to undertake. The third category of difference is returns. So when it comes to debt, as I mentioned, you get a fixed rate of return. So in the case of the fixed deposit example, when you invest money or when you give money to the bank gives you a fixed rate of return. When it comes to equity investments, as I mentioned, the returns are variable. If the company does well, you get good returns in the form of dividends and capital appreciation. But if the company does not do well, you don't get dividends or sometimes you get a capital loss. The fourth category of difference is time of payment. Now when it comes to debt holders need to be paid irrespective of the company's performance. So in the same example of fixed deposits, when you deposit money with the bank, you will get your fixed rate of return irrespective of how badly or good the bank performs. Irrespective of whether the bank is making profits or losses, the bank has to pay you the fixed rate of return. But whereas when it comes to equity, the shareholders are paid only when the company is making profits. So these are the differences between debt and equity. It is very important for you to understand the differences between the two because your portfolio should be in such a way that there is a right mix between debt and equity. So I hope you gained some bit of understanding between what is debt and what is equity. If you did like the video, please do comment in the comment section below and don't forget to like, share and subscribe. Thanks for watching. See you in the next video.